If you're confused by what happened in the stock market today, you're not alone. The Federal Reserve was extremely hawkish, that is bearish, and yet the S&P and the Nasdaq rose, with the Nasdaq up almost 1%. And this confused even me at first. I mean, I've been trading for 25 years, and this market never fails to surprise me and shock me. Now, luckily, there's actually a very good explanation for this. And even though it seems like the move was extremely illogical and irrational, there actually is a very logical reason why the stock market went up when the Federal Reserve was so hawkish. Now, if you have been hiding under a rock and you're not really sure what's going on, essentially the stock market has been rallying lately on hopes that the Fed would pause. And it all came down to this meeting. Would the Fed pause or would they raise rates? And the Federal Reserve did exactly what everybody expected them to do. They paused. Great. But then the Federal Reserve said something that shocked everybody. They released their statement of economic projections. And in that statement of economic projections is something called a dot graph or dot plot. Essentially, it's an indication of where all of the voting Fed members think that the federal funds rate is going to end up at by the end of the year. And what shocked everybody is the fact that the voting members see the Fed doing not one, but 2 rate hikes by the end of the year. Now, 3 Fed members actually expect either 3 rate hikes or 4 rate hikes by the end of the year, but most were expecting 2 rate hikes by the end of the year, and none, not a single Fed member, is expecting to cut rates this year. Now, this shocked the markets because the stock market had been pricing in not only a pause, but the stock market is actually pricing in the Fed cutting rates by the end of the year. And CME futures were pricing in a pause in June, an increase in July, and then 2 rate cuts by the end of the year. And when the Statement of Economic Projections, or SEP, came out, showing that the Federal Reserve was expecting not only to not cut, not only to not stop raising rates, but actually to raise rates not once, but twice. That is by far the most hawkish sentiment we have seen out of the Federal Reserve in pretty much the entire year. This is not what anybody expected. It was far more hawkish than expected, and yet the stock market went up. So what happened? Why did this occur? Well, the answer is pretty simple. First of all, you have to understand that the stock market as a whole did not go up. Actually, the stock market as a whole sold off. If you look at the Dow and the Russell, they both went down, with the Russell down about 1% and the Dow down pretty significantly as well. And if you look at the S&P and the Nasdaq outside of the mega cap companies, they actually went down. So the stock market as a whole did in fact sell off as expected, with the Federal Reserve being far more hawkish than anybody expected. Yet, the S&P and the Nasdaq still rose on the day, and the reason for this really came down to the mega cap tech stocks. The mega cap tech stocks rallied again today. Nvidia was up over 4%, and AMD was up over 2%. Now, Tesla did in fact fall. It has now ended its 13-day win streak, but it didn't really fall that much. Certainly not the major pullback you would expect after the stock goes up 41% in 13 days. But still, the mega cap tech stocks rose enough to cause both the Nasdaq and the S&P to rise. The Nasdaq is now up 11% over the past 3 weeks. And this leads a lot of people to question why. Why would these mega cap tech stocks continue to go up? And the answer really is quite simple. The Federal Reserve didn't cause the mega cap tech stocks to rally, so the Federal Reserve can't be the reason for the mega cap tech stocks to sell off. The reason that the mega cap tech stocks rallied had everything to do with the AI hype. And yes, the AI hype is extremely speculative, it's overdone, stocks are reaching insane valuations, and certainly at some point there's going to be a pretty major rug pull and those stocks are going to fall back down to reality. But the Federal Reserve cannot trigger that. They can't cause that to happen because the Federal Reserve isn't the reason for the rally in the first place. The reason for the rally is AI. Any tech stock that mentioned the word AI has gone up by 20% or more. Some of those tech stocks have more than doubled in the past 6 months. So the only thing that can cause mega cap tech stocks to go down would be for the AI hype to end. And it will end. It always does. We saw the internet.com hype end in 2000. We saw the massive rally and all the story stocks end in March of 2021. And at some point, the AI hype is going to come to an end as well. But until it does, the mega cap tech stocks won't go down. And so long as the AI hype remains, nothing the Fed does or anybody else does can possibly cause these stocks to go down. We could enter a major recession and the mega cap tech stocks could continue to rally. So long as the AI hype remains, the mega cap tech stocks will continue to go up. And this is why we saw the stocks go up today, even though the Fed was extremely hawkish. The vast majority of the stock market got it. The vast majority of the stock market sold off. But what didn't go away was the AI hype. And that's why we saw mega cap tech stocks rise. That's why we saw the NASDAQ and the S&P rise, even though the Fed was extremely hawkish. Now, let's go over a few really important things that the Federal Reserve said today to help you understand kind of where the Fed might go in the future. The first thing they said is they haven't really made any decision on what's going to happen in July, but market participants are expecting 2 hikes over the next 4 meetings. Keep in mind that in the late 90s, when the Fed was raising rates, they did a 25 basis point rate increase at every other meeting. Meaning it's very likely that we could get an increase in July and then another pause the next month and then another increase the month after that. And that's the most likely scenario at this point. The one thing that the Federal Reserve did point out, and they've been saying this, is that their main goal is to get inflation down to 2%. And they said that while we're seeing some progress in the headline CPI, which is encouraging, ultimately the Federal Reserve doesn't care about the headline CPI. That's not what they're focused on. So headline CPI could rot down to 1%. They don't care. What the Federal Reserve is focused on is core inflation. And core CPI is still at 5.3%, which is far above the Fed's 2% target. And one thing that Jerome Powell did say today is they're not seeing any meaningful decline in core CPI. They're not seeing it go down at all. And that's why they feel like they have to do more rate increases in order to get that core CPI down. Now, another interesting thing that came out in the SEP today is that they see the unemployment rate being much lower than they had originally forecast. They see unemployment rate going up to about 4%, but that's still way less than the 4.7 or 5% they were originally thinking, essentially coming in line with the fact that the unemployment rate remains extremely low, the lowest in 50 years. And they also see GDP performing a little bit better than they had initially thought. They're not seeing that major recession anymore. They're seeing more of a flat GDP by the end of the year. And essentially what this all equates to is an economy, at least the backward-looking data, an economy that is much stronger than the Fed had originally forecast. However, when asked if a soft landing was still possible, that is, to get inflation down to 2% without causing major economic problems, Jerome Powell said that while a soft landing is still technically possible, the Federal Reserve is going to do anything they can to get inflation down to 2%, no matter what that does to the economy. Essentially, what Jerome Powell is saying is he's kind of trying to get rid of the soft landing language. In fact, Jerome Powell didn't mention it at all until somebody asked. Essentially, they're throwing the word soft landing out the window. That is as dead as transitory inflation is. And now what the Federal Reserve is focused on is, look, we're going to get a recession. It's coming. We know it's coming. But we are going to get inflation down to 2%, even if that means we enter a hard recession. Fed doesn't care. They have to get inflation down to 2%, period. Doesn't matter what it does to the economy. It's essentially the message that Jerome Powell was giving today. Backing that up was saying core inflation is not coming down, and so they have to raise interest rates more. And further predicting that the economy is going to get much worse in the third and fourth quarters of this year. Now, when looking at how companies are currently performing, a lot of the rise in certain stocks had to do with the fact that spending appeared to be quite good in Q1 of this year. But what I think a lot of people overlooked is when those companies reported, what a lot of them said was that consumer spending was strong in January, but they saw it taper off in February and March. And if that slowdown in consumer spending continues throughout Q2, then next earnings season, which starts in about a month, the Q2 earnings are not going to be good at all. And CNBC did a survey today and found that 92% of Americans who are middle class are cutting back on spending. 92% of middle class Americans are cutting back on spending. And that can't be good for the earnings for companies. And that's why when you look at a market index that's not weighted, an unweighted index of the overall market, we see that while it has risen this year, it's not up nearly as much as the weighted indexes are. Because overall, stocks are still struggling. Companies are still struggling, and a recession is still coming. But while we currently are in this AI hype cycle, mega cap tech stocks can continue to rally. The NASDAQ and the S&P can continue to rally. And a few other meme stocks, or just whatever happens to catch the attention of retail traders, stocks like Palantir and others, they can rally as well. Far, far above fair expectations. Because right now, the fundamentals don't matter, at least on some stocks. Right now, nobody cares about fundamentals. All they care about is the story. What is the company going to do in the future? Look at the technology. Look at the story. Look at the growth potential. This company has such a great story. Buy it because of the story. And look, that worked out great for about 6 months from the end of 2020 to the first 3 months of 2021. And stocks rallied and people made a ton of money. But don't forget to sell and take profits. Because people in 2021 didn't sell. They didn't take profits. And they ended up holding a bag. And by the end of 2021, their portfolios were down 60 to 90%. Because every single stock that rallies on a story with no fundamental backing eventually falls. People who buy story stocks get burned if they don't take profits. So buy the hype, enjoy the rally, enjoy the run up, but don't forget to take profits. I don't want to see you a year from now after the pullback has happened and these stocks have sold off, holding a bag, wishing that you had taken profits. Take profits now, enjoy your profits, before the rug gets pulled. Now, regarding a lot of the other stocks in the market, a lot of them remain value stocks. A lot of them remain undervalued. Of course, we're buying those stocks in the Millionaire Club portfolio. If you want to know the other things that we're buying, all of the options trades that we're making and the money that we're making as the market goes up, down, and does all the crazy things it's doing, we're main coach in there, Coach K, she had a mastermind in May, and the trades, just the public trades, generated a $13,000 profit in May. If you want to make $13,000 a month in your portfolio, I encourage you to come join our coaching program. Now, of course, I can't guarantee you're going to make money. It takes years of practice and experience to make money. But every single tool that you need to learn how to eventually get to that point where you can quit your job and just trade full time and vacation with your family and do whatever it is you want to do. Every single tool you need to get there is available for you in the coaching program. And I want to help you get there. I want to help you be successful. I want to help you be able to quit your job and trade full time just like I do. So in order to help you out with that, in just remembrance of Juneteenth that's coming up on Monday. By the way, if you didn't know, Juneteenth is a holiday here in the United States. It essentially celebrates the very last day where slaves were freed in the United States, and we call it Juneteenth Day. And in just remembrance of the freedom that the slaves in America had, I want to help you achieve your financial freedom by joining the coaching program. And to help you do that, I'm now offering a 10% discount off the coaching program through Monday. That's 10% off the masterminds, 10% off the annual plans, and 10% off the lifetime plans. So if you're interested in that, you want to take advantage of the sale that's running through Monday, you can sign up for that by onboarding specialist. Just give them a call at weprofitdayandnight.com. That's weprofitdayandnight.com. Just click the Learn More button, and that will take you directly to the Calendly where you can schedule a call with the onboarding specialist and get into the coaching program. Also, if you didn't know, Monday is a holiday in the United States and all the markets are closed. So plan your options trades carefully on Thursday and Friday. If you do, in fact, plan to hold them over the weekend, it is a 3-day weekend here in the US. If you got a lot out of this video, don't forget to hit the like button and subscribe. Share this video with your friends and family. And if you missed the last video I uploaded, you can watch it right here.